Hi everyone, Matthew Levy here from WealthMore Portfolio Strategist. I just wanted to give a quick update on some of the news you've probably been seeing, and today we're going to talk about Moody's recent downgrade of US government debt and what that means for the economy, the markets, and most importantly, your portfolio. Spoiler alert, it's not the end of the world, but let's unpack it anyways. Late Friday last week, after markets closed, Moody's, which is one of the major credit rating agencies, they lowered the US credit rating by one notch. Sounds scary, especially if you read some headlines, but there is some perspective here. It's kind of like going from an A plus to an A. It's still a top grade. You're just not, no longer perfect. It's not the first time this has happened. Other major credit agencies did the same thing back in 2011 and even more recently in 2023. The headlines are loud, the markets wobble for a day or two, but eventually keep climbing over time. Especially back in 2011, I remember the markets, it was kind of the first time this had happened in recent history, and the markets tanked pretty spectacularly. So it's good to keep some perspective on the recent move. This time wasn't any different. Stocks had the weekend to kind of digest the news. They did dip on Monday morning, but actually they recovered by the end of the day in the green. So it's kind of like you get a dent in your car. It's annoying, but it's not going to really affect your driving too much. So why did Moody's make this move? Basically, they're saying that for many years, the US has been spending more than it earns. You've seen it in budgets and budget deficits, and they're talking trillions and trillions of dollars. So this has been happening year after year, and there hasn't really been a real plan to fix the trend. So that's fair criticism by Moody's, but it's also been true for a pretty long time. If you have a friend or two with really high income and they're maxing out their credit cards and don't budget, eventually the bank's going to lower their credit score even if they have a super high income. It's not because they're broke, it's because the trend is risky and they need to adjust for that. That's really just what Moody's is flagging. Even with that, the US is still seen globally as one of, if not the safest place to put money, and that's really not changing anytime soon. But should you be worried? Short answer, no, I don't think so. For regular investors, people with retirement accounts, mutual funds, or ETFs and long-term portfolios, the downgrade doesn't really mean you need to take any action. It's just something to be aware of, not something to react to. You're going to hear about interest rates on things like mortgages and credit cards. They could go up slightly over time, but that's really already been happening due to recent inflation and Federal Reserve policy, not just this downgrade alone. So we need to separate the headline action from what's really happening. And when we look at past downgrades as well, it's a pretty clear pattern. Stocks tend to bounce back, bonds will settle down over time, and those who kind of stay invested will come out ahead. So if anything, moments like this and headlines like these are just a reminder to not build your plan around what's going on in the headlines. Build it around your goals, your timeline, your life, really. And if we're going to take one takeaway from the last week, it's don't panic. The Moody's downgrade is a headline. It's not a crisis. Stay invested and focus on your plan, not the noise. That's what really separates true investors from speculators. Markets are always going to have these short-term bumps. We saw even more so in April, but long-term markets tend to reward discipline, not fear. So thanks for tuning in. If you have any questions, feel free to reach out. We're always here to help. Until next time, talk to you soon.